hey, I really think it's going to be higher than this in a very short amount of time. So that's why I felt like options would be an effective financial tool to extend the returns for a limited loss.
Wow.
And I not only that, I was so bullish. I I kind of also mortgaged my house. So
Hey there! Welcome back to Tolusnotes. On this podcast, we'll explore how young adults invest their time and their money. I also have a newsletter filled with priceless insights for young investors. Subscribe for free at tolusnotes.com. Today's episode is a bit different. I'm having a conversation with Tad Park, one of the most concentrated investors I know. He made big bets on Tesla in 2019 that paid off handsomely. Now, he is creating a set of growth ETFs focused on disruptive tech companies so everyone can benefit from his thesis. We talked about the benefits of concentration, convexity, and the culture of innovation and disruption. Enjoyed the episode. All the material discussed on this podcast is for educational purposes only. It should not be taken as personalized investment, tax, or legal advice. It is not an indication to buy or sell certain securities. My guests and I do not guarantee the accuracy or completeness of this information. As always, do your own research.
Tad, how's it going, man?
hey Tolu. Yeah, it's great seeing you again.
Good seeing you. It actually hasn't been that long. I think we chatted a few weeks ago, right?
Yeah.
Yeah, nice. Welcome to
it's
the
really
show.
nice. Yeah.
Yeah, so you're actually one of the first subscribers to the newsletter, and I think you're one of the more faithful readers. In that, no, seriously. In that you actually you read and you actually email me back, and we actually have conversations about things I wrote. You know, we debate on things. You don't necessarily just agree with everything I write. Neither do you disagree with everything I write. We just, it's kind of nice to just have that, healthy back and forth on things like that. So yeah, thanks for being one of the earliest newsletter subscribers, man.
Yeah. I just love that we were able to just kind of talk about things before when we were, just kind of getting coffee and things like that when in more normal times.
Yeah, those
Yeah.
coffee walks we used to do to Phil's actually inspired me to start Tolusnotes. Yeah, so just in case you didn't
Awesome.
know.
Oh, wow. So I was
Yeah.
in the beginning,
Yeah, you were
not
there at
even
the beginning of
not
it.
even just a newsletter. Because the conversation was so interesting. I felt like people need to hear this more. This is like so great, like to have a very reasoned thoughtful process to investing.
Definitely.
Instead of just like, oh well, whatever, I don't know about investing, so I'm just gonna put it everywhere and then
I think there's definitely a couple buckets to that, in that there's some people who just don't care about it, and that's perfectly fine. If you don't care about it, it's good if you just automate it, let someone else handle it for you. But there's some who want to care about it, but I don't think they're willing to just learn or even just have conversations, mostly because, if you, like we're gonna have later today, I bet you're gonna say some things and that's not gonna be my style, right? Or I'm gonna say some things, that's not gonna be, but like humans, I don't think we want people to disagree with us, right? It's really difficult for us to have conversations, or for us to say, oh, I bought this stock at X price. And when you tell someone else that, they kind of go, I'm not sure if that's something. And then you start like second guessing yourself. And a lot of people don't like that, even though it's really healthy for people, especially investors. So yeah, well, let's dive right into it, man. Tad, let's talk about Tesla. I feel like from the very beginning, I think you're the biggest Tesla bull I know, in that even from all the YouTubers I watch, I don't think there's anyone who's as bullish on Tesla as you are. And that's because you were kind of there when no one believed in anything, right? And you weren't just there with like shares, you were there like with options. You placed an actual bet, and you had this crazy conviction. So I think we've discussed this many times, but like, tell me, what is it about Tesla that you believed in back then? Like, let's just rewind a bit. Like, not what you know now. This was back when the board told Elon, you have to get to the share price. If not, you're not going to get that big payday and so on and so forth. And a lot of people didn't think they were going to hit their numbers. A lot of people didn't think they were going to get there. Why did you believe in Tesla then?
Yeah, so I think that Tesla, I felt like, was the biggest investment opportunity of my lifetime at that point. I've been following them for a while.
Mm-hmm.
And at that point, I was just so convinced of Tesla. I felt like it was my obligation just to help other people. Like, I was telling everybody, and like you were there, but like I was telling not only people at work, but my family members, people I knew, friends, everybody, and they would just be like, "Hey, stop talking about this." Like, I think some people like didn't even like me, but like I knew that it was going to completely change things, and whoever listened would be really appreciative for investing in it at that time. So I knew that at that time I would look crazy, but one day some people would thank me. And what I really liked is at work, at the very end, some people did thank me, that I made people aware of this really crazy stock that I felt was really going to change the world and go up in a short amount of time. So actually, a lot of that was after the Autonomy Day presentation, and that was in April. What was really weird is that presentation happened, and then the stock wouldn't keep getting hammered. So there was a recent Battery Day presentation that happened a couple of days ago, and I think people just, a lot of people got into Tesla just recently, so they don't really remember that after each of these presentations, like I'm not surprised when the stock goes down after a presentation. This is actually quite a common experience that I've experienced. So like Battery Day, stock went down, but after Autonomy Day, stock went down and wouldn't stop going down. After the Cybertruck reveal, people were like, what the heck is this? Stock went down. Each of these presentations, the stock is going down. And I think that, of course, to the presentation, people are all excited. But one thing about Elon is that he really sucks at presenting. Like he stutters,
Agreed.
all this stuff, like whatever.
Yeah.
I think the big difference is with Apple, Steve Jobs was a presenter. Like he could get this vision in your brain. Like he's very, very good at presenting and pausing and doing all that stuff, suspense. Elon's like really bad at all that stuff because he's more of an engineer than a presenter. And I think what that created was that he can say something world changing, but if people don't understand him, they just dismiss him as a crazy guy. And that created one of the greatest growth opportunities in this stock. Basically, when he was talking about all the stuff about how autonomous driving works and all this other stuff, I was like, wow, NVIDIA is like huge, like over $100 billion, and Tesla's only $50 billion, but they created a chip that's superior to NVIDIA, and they have the technology with machine learning to actually like solve self-driving, which would make this a like $1 trillion plus company. When I saw like all these things coming to a head, like, and their technological advantage in batteries, technological advantage in like so many different things, and that the world is going to go electric because it's a superior technology, I felt like there's no way that this will be valued the way it is. So during that time, news media was just hammering everything and saying, oh, this company is going to go bankrupt, et cetera, et cetera. But as long as the company is able to raise money, I feel like they can achieve their goal because they just have to survive long enough to raise the money. So I thought in my mind, they are not going to go bankrupt here. And I specifically remember having lunchtime conversation. I was talking about Tesla again with coworkers. It was at 178. That was the bottom. This is like, it may never hit 200 again, or be below 200 again. So this was pre-split, so it's about $50 a share. And they, of course, a lot of people didn't believe me, but that was the bottom. And I think that the reason was everyone's saying it was going bankrupt, I knew for sure it's not going bankrupt. So it's actually a great as well. So options are usually very risky, and I wouldn't recommend it unless someone really knows what I'm doing, knows what you're doing. I didn't know what I was doing, but options are forgiving if you're on the really right side of the equation. Like if you're correct, then it can be forgiving if you didn't pick the right prices, the right strike prices, all this other complicated stuff. So all I knew was, hey, I really think it's going to be higher than this in a very short amount of time. So that's why I felt like options would be an effective financial tool to extend the returns for a limited loss.
Wow.
And I not only that, I was so bullish. I kind of also mortgaged my house. So you know,
that's one of the funny parts that I knew, and I wasn't sure if you would be willing to share it, because when you shared that news with me, I think the first thing that went through my head is like, make sure you don't tell your wife. But
Yeah.
okay, this just seems crazy, because right now everyone, anyone can say I told you so in retrospect, but you again, I'm not saying this is a good investment, by the way, and I'm going to put a disclaimer all over the place just to make sure. But what if things didn't go your way, right? Because you put up a mortgage on your house, you were in it with options, which definitely had expiration date. There were a lot of things that could go wrong, right? You mentioned that options are really forgiving. But the only thing that options really strict about is that expiration, and once it's done, right? So there were a lot of things that could have gone wrong. What would you have done if things didn't go your way?
Yeah, so I think that's a really good point. I think that if I didn't have certain things in place, I wouldn't be able to risk. So I'm a big proponent of the FIRE movement and like very smart investments and stuff. And I was building up to that point for quite a while. So I actually live in a fourplex that I own, and I have income coming in from rent, and I had emergency fund, and I had all these things in place already. So in any scenario, even if I lost my job or anything, I wouldn't be in a hard scenario that I would have to, mess up my retirement savings or like anything like that. So in that situation, the way I thought about it is, in the Silicon Valley, we take pay cuts all the time. And we take pay cuts for options, essentially. So these are options in world-changing companies. And if it goes crazy, basically this is, just how it works, is that it really helps people, and sometimes people retire early. But it was an affordable risk because the salary is high enough that you can afford like a 10% pay cut or whatever, or a 5% pay cut. So in my mind, I was thinking, hey, people use a home equity loan to do like really stupid stuff. I mean, in my opinion, stupid stuff, but I mean, they might think it's really fun to have like a car or a boat or like just random stuff that don't have any return. And then they just pay it off like a gigantic credit card over time. So in my mind, it's like, hey, this is an investment that I really believe in. If I'm wrong, this is not unlike other trade-offs I've had in my career, where I took a bit of a pay cut to have a piece of a world-changing company. And basically, if I'm completely wrong and it goes bankrupt, at least I'm only risking a small pay cut. And I feel like because I've done really well as a software engineer, I could keep working as a software engineer for many decades. I could easily pay this off, even if Tesla went bankrupt. So this is not a typical investment or like a wild investment in that, people are just like putting everything and on like a blackjack table or something. Like that's not how I was viewing it. I was viewing it as the expected value of this investment, I believe, is really, really positive. So it's worth it to put in as much of my expendable investment allocation into this investment as possible. And I viewed it kind of like a VC, not a VC, but how software engineers join a company and they put a portion of salary into the company, but without having to work at Tesla. So this was like the best way to, without working your butt off at Tesla, have a piece of Tesla. And actually, it's a lot bigger piece of Tesla than even an employee at Tesla would have if I were able to approach it that way. And that's how I thought about it.
Have a piece of Tesla without dealing with Elon Musk. All right,
Yeah.
smart. Okay, so we're moving on here. So that Tesla bet was really concentrated, right? Just in its nature. I think you mentioned some comparisons to others, but most people diversify, myself included. I hardly have enough conviction in a specific company to do as well. My convictions are with like the broader market movements. Like I think you know some of it about like shorting retail at the beginning of the year, buying heavily with margin and mid-margin, things like that. That anyone else who subscribed to the newsletter would know about. But so I don't really target like specific companies. I just sort of look at either industries or the entire market as a whole from a macro level. But you're one of the few that actually target specific companies. So what does it mean to be a concentrated investor, and why won't you just diversify?
Yeah, I think it's a bit of a different mindset and a different risk tolerance. So if you think about all the billionaires that are out there, pretty much all of them are heavily concentrated in one or two stocks. And that one stock might be a company that they founded. But we don't hear of any billionaires that became billionaires because they were, diversified in the S&P 500, or they were, doing anything like that. So it was a high conviction investment to have a big part of a world-changing company. So I believe that it's necessary to concentrate in order to grow wealth, but it's necessary to diversify to preserve the wealth. And in my stage of life, I'm willing to take that bet as if I'm an entrepreneur starting a business, and I'm willing to take a little bit more risk. Because I'm young, I can recover from a couple mistakes. And then at the end of life, if I want a very stable, low volatility investment profile, I can switch over at the end of life, right before retirement. But for right now, I felt like this is how people grow wealth. And without risk, there isn't an ability to grow that wealth. And just because of my own investment goals, this is not recommended for everybody. This is just the way I thought about it. I wanted to increase my risk profile earlier on in life and then decrease the risk profile later on.
Smart. And these are some of the things I write about on the newsletter, even though it's still not individual stock level. But when you're young, I think it's the best time to just take a lot of risk, just seeing that you have time on your side. Okay, so moving on here. Before we actually move on, what's next for Tesla? Where do you see the growth coming in? I think people have always said that stock has been overvalued its entire lifespan. Disclaimer: I'm not a Tesla shareholder, but where do you see it going now? Because you're obviously still bullish on the company.
Yes. So I'm not. None of this is investment advice, though I am a shareholder. This is the way I view it when I do my own investments. But basically, I see world-changing companies like Amazon on this whole ride up to over $1 trillion and things like that. And they were saying that they were overvalued the entire way up by all the traditional financial metrics, always overvalued. But they were world-changing. And I think in the same way, if you look at a disruptive company from the traditional financial lens, it doesn't make sense because they are using those profits to grow and to set up the infrastructure for world change. So you can't say, oh, this is the PE ratio, it seemed overvalued, all that stuff. none of that stuff applies to a disruptive growth company. And that being said, even as an auto, it seems like it's a little overvalued because, you know, Toyota, Honda, GM, and Ford, all of those companies combined is the same value as Tesla now. So it's almost the entire auto industry.
Mm-hmm.
So you can argue, well, even if they execute and everyone's driving these things, you've hit your value, so there's no, you know, you can't get any higher than that. And I understand their viewpoint, but I think that if you view it as a technology company, it's completely different. They are in the midst of unlocking so many technologies, and they are going to be the backbone and the leader of the electric car revolution. And not only that, I think the most promising aspect is autonomous cars. So right now, yes, they're ahead in electric vehicles. Yes, they're ahead in all these things. That's why Wall Street is still pricing them around the current price, maybe about 30% lower. But they're in the ballpark of the current price because they're a leader in this field. What they are not pricing in my opinion, is what value would be unlocked when autonomous cars come into the picture. So if you look at Apple is a $2 trillion company right now. They sell these, you know, $1,000 phones, and yes, there's recurring income from the apps that you buy and the App Store and things like that. Their margins are pretty healthy, like over 35%. But, you know, in the end of the day, they are a hardware software combination, selling mainly $1,000 phones, and they're $2 trillion with healthy margins, right? Now imagine a world with autonomous cars. You're not selling $1,000 phones, you're selling cars that are $25,000 to $50,000. And imagine applying healthy margins on top of that. And those healthy margins are possible if you charge on a recurring basis because of the autonomous car, that the car is driving itself, and because you're the software platform, you can charge that on a recurring basis. So once that's unblocked, is it really overvalued? Like, is it really overvalued to be in the trillion or over $1 trillion or in the trillions? I would say that at that time, people would view it as pretty affordable for the service that they provide and what they're providing society. And that unlock has not happened yet, because that will unlock incredible value. So it's a critical question to answer whether they are on track to unlock this technological breakthrough or not. And that is what I want to provide to the world with
awesome.
my.
I want to move on so bad, but like there's so much to touch on, so I really hope you have some time. So, are you familiar with the diffusion of innovation, the chart, where you have things? Just imagine exactly how the Bitcoin chart. That's the exact diffusion of innovation chart, where no one knows about something. You get some early adopters, and then there's like hype.
Yeah.
There's like overvaluation, and then there's like a crash all the way back down, and then things kind of stable back up, and things move on from there. So with that in mind, and that's how a lot of technologies happen with the internet. Also, the 1999 tech bubble was the hype spot for Bitcoin. That was when it reached 19,000 or whatever it reached. And don't you feel like for self-driving cars, Tesla, whatever, there's going to be that bubble / hype phase? I'm not saying that the company won't make it. I'm not saying that there's anything wrong with what they're trying to do. They're a benefit to humanity as a whole. But don't you feel like just because it's human nature to be greedy and we're never at any equilibrium, aren't you scared that we're eventually going to drive up that price all the way to the overvaluation level? Then it'll come crashing back down before the true nature of the stock, before we actually see what Tesla truly is, or autonomous driving, or the auto taxis, whatever you want to call it.
Yeah. So yeah, this is an interesting question that you bring up, because I actually am pretty involved in launching these funds. So I'm launching funds with the company that I started is called Bolt Equity. And one of the things that we apply is this concept of convexity. And it's specifically for that. Usually disruptive companies, they're not quite understood by society, and the stock movements can be very, very sudden. and it can just be very disorienting, but it actually produces a lot of financial opportunity in the derivatives market. So like things when you use options and things like that. So basically with this concept of convexity, you can protect against the downside when it does crash. We actually expect for these contentious like battleground stocks, before people fully understand them, to have a pretty wild ride. And the way that you can invest in that is with convexity. If the stock moves really fast up, you can move faster than that because there's options. And the options do not price in that a company will be disruptive. They think that the company will just be as it was before. So you can get options for cheaper than what it affords you if they are disruptive. And when it crashes, you can have protection because other people are not expecting the crash. It's possible to have some protection from a broad market crash so that if it tanks, you have a little bit of protection on that side as well.
Okay.
And of course, nothing's free. So
Yeah.
there's a cost to carry to these options.
Yeah, there's definitely a lot to unpack there, but yeah, what I'm understanding now is that you have both calls and puts. So you're riding the momentum all the way up, but then you're also trying to protect yourself against the momentum crash at the bottom.
Mm-hmm.
Is that a correct assumption?
Yes. It's just not from like the thing is, if it was it's possible to achieve convexity with like no foresight whatsoever. Like you could just do it on any stock out there, right? So you can just buy calls on the way up, puts on the way down, and it just basically washes out because it goes by the market movement. Actually, you would lose money because nothing would happen really. Yeah. Like you would kind of gain a little bit, kind of lose a little bit, and then you'd kind of lose money over time because you have to pay for these premiums.
Yeah.
Now when it gets really effective is if you view it as an insurance premium. So if you put a very small exposure to options and the market did not price it in as a world-changing company, you can have really outsized exposure to this upside. As an example, I put into my own option software. I use E-Trade and I have this like power terminal and things like that. They said it was like a 1% chance that Tesla would be above 1,000 or something like that by the end of this year. So at COVID, I was like, okay, I'm pretty sure that this can recover. And I was basing it on like many different things.
Yeah.
But I guess not right now. But I was like looking at the logarithmic chart as opposed to linear chart, and I was like, okay, millions are not going to die. So then there is actually more than a 1% chance that the Tesla stock is going to recover. So I spent $3,000 for a $1,800 call option, and then recently that was worth $700,000. So something that I put in $3,000 for became worth $700,000. That's the asymmetric return. And now imagine if you had a very big portfolio, by only risking a small premium, that's completely like this so underpriced for the true probability of it hitting that price. So the market thinks it's a 1% chance that it's going to hit that price. That's why they're willing to sell it to you for $3,000. But imagine if the true probability was 30% that it would hit that price. Then actually that's really cheap. So if you apply this options overlay, as long as the company is disruptive, you can supercharge your returns. And this is so different from other types of investing out there. Normally, when people introduce options and things like that, in a fund context, it's leverage. So it's super easy to borrow $100 when you have $100 and double your return, but you're actually doubling your risk as well. Because when it goes down twice as hard, and you have like risk of bankruptcy and all this crazy stuff, right? So it's super easy to like ramp up the borrowing and ramping up the risk. It's really hard to increase the return while keeping the risk managed. And that's when it would be really interesting opportunity. And that's what convexity unlocks. is that this is not a pure leverage product. It's meant for people who are going to hold it long-term and long-term growth investors, but also adding this layer of disruptive convexity, that you're being able to supercharge companies if they truly are disruptive because it's not priced into the market.
Okay, so this won't work with just any company, right? Because if a company is growing at exactly at the expected rate, your options would never make you any money.
Yes, exactly.
So
You would actually lose money. So
okay.
It's only if the thesis is correct that it is a very well
In the time period, right? It has to be
Yes.
correct it has to be correct and realized in the time period.
Yes, exactly.
Okay. So, and that's just a warning for anyone thinking of doing this with SPY is that, or like the S&P 500, is that the S&P 500 is really, the expected volatility, that usually is the case. And something like what you just mentioned would work in a black swan events, in a black swan event like the coronavirus, but 9 times out of 10, you're just losing money if you use something like this on the S&P 500.
Yeah. If I could kind of go on that.
Definitely.
Yeah, so this is not related to the funds that I'm planning to launch and bring to market, but some of the partners that I work with, their Simplify Asset Management, they have normal convexity, not disruptive convexity. So they're helping me achieve invest convexity in my own portfolios, in my own funds, but they have normal convexity over the S&P 500. So you would think that putting an options overlay would be not worth it, and it just all is a wash because it's very expected. But amazingly, like in their own, like this is all hypothetical, you know, past results do not guarantee future returns, but when they did a lot of rigorous back testing over many different time periods, they were able to greatly exceed the return of the S&P 500. And those drops were completely unexpected by the market, and they were able to get it so that the portfolio did not drop that much, if at all, sometimes even positive, depending on the severity of the drop during those crashes. So if there was a crash in year 2000, there's a year crash in 2008, and then this crash in 2020. Yeah. Just those crashes happening like once every 10 years or something allows you to pay the value of that insurance and greatly exceed the returns of the S&P 500. And I was very confused on how that was possible, because you would think that it's all priced in for something as well known as S&P 500. And I think it's the concept of humans doing things that are not correct because of psychology, and you being someone who always does the correct systematic move according to all of history and society. So how this would work is, like you were saying, it's totally correct. Someone tries to do this themselves, because of psychology, they might do it wrong, actually. Unless you have this really crazy system and like algorithms and all that stuff, most likely it's not the correct way to do it, in the sense that they think in their mind, they bought a put option and it keeps expiring worthless, right? And it's actually 95% chance that it's going to expire worthless. So you're thinking in your mind, do I want to, I didn't hit my price target, so do I want to make $1,000 by selling this put option and closing it out right now? Or do I want to hold it to expiration and make it expire worthless? So over time, they're training their brain that 90% of the time it's expiring worthless. So they training their brain to constantly sell it before it expires. But what this creates in the market is humans are actually making the wrong decision, because they're not also factoring in the probability of a crash. And then when you also factor in the probability of crash, that might actually be a very cheap option for the insurance value that it provides. So if you're systematically doing it in a system, then it might actually allow you to save yourself from a crazy crash and get outsized performance over long periods of time. So in the short term, yeah, there's all these day traders and all that stuff, but they're not thinking about the probability of these like crazy events. So then
Gotcha.
that depresses the price of the protection, and you can buy the cheap protection as insurance. So this is not a pure leverage play. This is an insurance play. And I believe that Simplify is at the forefront of that. And they're first to market in this disruptive financial product where they can treat options like insurance and buy up these cheap options that, 90% of the time will expire worthless, but in all of their back tests have proven very promising to exceed returns and be better than holding bonds
Gotcha.
for the protection it provides.
So I'm not fully familiar with Simplify or what they do, but let me see if I can share my screen right now. And I'm sorry for those listening on this through Spotify, they're not gonna see this. So this is SPY.
Yeah.
And CBOE has this index called, it's just P put. And what they do is they take 5% of the portfolio and they buy, I don't know if it's 5% of the portfolio, but they buy 5% out of the money puts with this. And so this is the performance over like a long period of time. Let me see if I click on the all chart. You can see since its inception, the put would have outperformed risk in recent history. So year to date, it outperforms. You can see that's exactly when COVID hit, and that's when the outperformance started. But so I was reading this on AQR, and what they found out was that it underperforms the S&P on average by 4% over, I think, a 20-year period. And they said doing this is really equivalent to just holding less than 40% equity and throwing 60% of the rest of your portfolio in just cash. You would have matched the returns of this just like 5% out the money pool. Obviously, I don't know what Simplify is doing, but this is just how this is designed. And what they found out is that this is the outperformance is due to two things. And the first is the negative equity beta. Obviously, once you're selling some of your portfolio to buy puts, you're selling out of stocks. So you have like a negative beta, which isn't necessarily a bad thing because that also reduces your risk. So we can kind of ignore that. It's like, oh, less equity, less risk. Let's just kind of ignore that. But what they found out is like the second one is due to the volatility risk premium. And this is the premium the people who sell the put are collecting every time you buy the put from them. Yeah. So so this, obviously this doesn't work. We can see that it'll work this year, but this is a black swan year that occurs, let's say, very rarely.
So how much has it outperformed in the past 7 years, for example?
So I don't have like the 7-year chart. I have like the all, but it's kind of misleading because their spike chart is pretty weird.
Even 5 years, how
so
has it?
5 years, it's 79% versus 29, so about 20% over from just from COVID. So no, I'm not saying something like this doesn't work. What I'm really just saying is that the most important part of this is the human psychology, right? Because I think Simplify also launched ETFs, right?
Yes.
So once COVID hits and everything starts tanking,
yeah,
there are people who may sell Simplify, even though it may be the only thing that's green. They'll sell it just because the entire market is going down, right? Because human psychology works that way, in that it doesn't matter what's going on at that moment. Everything that your brain just goes to, let me just conserve cash. Let me stop losing money. So you sell what's up, you sell what's down. It doesn't really matter. You just want to get out of everything once everything is tanking. Or if Simplify, they launched an ETF, I'm not sure if they're an hedge fund, but like I think I've written about this multiple times. But so as much as this is designed to work, if you just forget that you have it and you just let it do its own thing, every 10 years we have a black swan event. there's like a fat tail distribution, something happens, you make money. But you have to be willing to go through 9 years of underperforming, right?
Yeah.
For
So
this to be able to work.
yeah, well, unless you have a 1% call and a 1% put, then you also overperform during the bull market and during the crash in both scenarios. So that would be convexity, which is kind of counterintuitive, that you can actually exceed the value of the premium for both of those things.
Gotcha.
And that's only, I shared an article in the chat, but it's only if you're buying it very affordably.
Gotcha.
So I think it really matters. You can't just say, I'm going to blindly buy puts that are 5% or X amount out of the money, and then that's my ETF. These are like people who are very, very good, and they are using a lot of brain power to basically act like an insurance company. So it matters what kind of risk premium they assign each person when like a car insurance company like Geico assesses you as a driver.
Yeah.
If they get that risk number wrong, they'll go bankrupt. So they're very, very good at assigning what the expected value is and doing the right move over and over and over many, many people. And that's how they're able to be a very, very strong, profitable company. So in the same way, instead of doing random contracts and saying, hey, you guys all get the same insurance premium for driving all across the board, across the entire nation, if they're very wise about it and make sure that it's very cheap, they can really like use this as a tool to have outsized protection for the amount that you're risking. For SPYC, it's only risking 2% of their portfolio, 1% for puts, 1% for calls, but yet they're able to have outsized performance in the past. If this is all, of course, all hypothetical, but in this blog article I shared with you, between 2007 to 2020, the benchmark return is hypothetically 200% for the S&P 500. But this strategy has over a 500% return in the same period, with less volatility. So
let me share just so those that are watching on video on YouTube can also see this. So this is the article you just shared. I'm seeing this for the first time. I haven't read it yet. But what you're saying, so this is what you're pointing to in that. So they were able to beat the S&P 500. Volatility is also lower, and some people view volatility as a short-term risk. So I see that maximum drawdown as 36.
Is lower as well.
So you won't be, the hurt doesn't feel as painful, right?
Yeah.
So, this fund expects a huge black swan-like crash, drop, whatever you want to call it, let's just say they time it for every 10 years. That's kind of on average what I would happens. So what just happens if we have like a long period of just outperformance? Are you still saying this fund outperforms even when the S&P 500 does well? Because I'm looking at the chart here and I see did I stop sharing again? I need to just keep it on. In 2019, for example, which I think the S&P 500 returned, 30% or something crazy like that. The fund underperformed. In 2018, where we actually there was a drop at the end of 2018, but the drop wasn't big enough, I'm guessing. So the fund also underperformed. It underperformed in 2017. It underperformed in 2016. So this is the underperformance I'm talking about, in that there are a lot of people that won't be able to stick with something like this, even though something like 2020, there's this insane asymmetric return that they would have profited from.
Yes, and I'm really appreciative that you point that out, that it's sometimes people misunderstand it and say, hey, the S&P 500 went down like 0.68% today. Why is this fund down slightly more? It's supposed to save me from all downturns and all upswings. It's supposed to be like better in every single way, but it's like, no, that's not how it works. If you do compound returns, it's better compound returns. So imagine you have like, you know, just one event where it's like crashes everything. That can completely kill your portfolio and you have to start over again. But imagine that was not a reset for you. Then when you multiply each year's return over time, over a long period of time, your overall return will be a lot better by just having some protection. This is all hypothetical, but that's kind of the idea. And that is what people do for bonds, actually. So right now, sometimes, you know, traditional portfolio manager, money manager would recommend like a 60-40 mix, 60% stocks, 40% bonds for those times where, you know, things crash and stuff. Because the bonds are returning, you know, 3-4% or something, it doesn't matter because less of your portfolio was exposed to the crash. So that's like a typical normal portfolio theory. This is applying modern portfolio theory. So, I mean, we're not even talking about current environment where bond returns suck and they're like less than 2% and interest rates are all-time lows. The previous way of thinking about protecting a portfolio may not apply anymore because the interest rates are so low. But assuming that the interest rates are normal, this might be able to give you outsized performance because yes, you are underperforming by worst case scenario 2% because it's 98% SPY, 2% insurance. Say it's a worst case scenario, everything's always flat. You're always underperforming by 2% and it's always expiring, right?
Oh, sorry, you broke up for a bit. You're always aspiring. Could you repeat that part?
So you're only exposing yourself to the 2% premium in a normal kind of like worst case scenario where the markets are flat, right?
Gotcha.
But then when the markets are, but then for bonds, how does that work? I mean, you keep the 40% bonds and later in retirement, it's like 60% bonds or whatever that is.
Yeah.
Because the market might crash. And what is that differential? The differential is huge now. Instead of the S&P 500's 10% return, the bonds return is 1%, right? So instead of having this huge cost of carry, which is having bonds in your portfolio, what if you can remain in the market? And yes, it's a little bit less return than S&P 500, but you're getting that protection that the bonds would have provided you as a better alternative to you know, keeping stocks and bonds.
I see.
So it's like a creative way of getting the same protection and having more exposure to the market.
And have more exposure to it. Gotcha. Okay.
Yeah, it's not meant for everybody. It's actually meant for like actually like asset managers. So they're actually targeting asset managers who will know, hey, if it crashes, don't sell this because that's what this product is meant for.
Definitely. If you can get me on some white papers or some of the studies they've done with actual data, I promise not to share it, but I would just love to like nerd out and to read what they're doing with this. So
we can talk about that later. Yeah,
definitely. So moving on from this, how are you using this in Volt equity? So I see this convexity and using this puts and then the call and that 2% that you're putting aside for these options. How are you going to use that in the funds that you're launching?
So for the funds that I'm launching, it's not going to be 2% or whatever. It's a different market. So it will be probably a higher options percentage. But I think that the concept of convexity and the execution of it, I don't think there are other partners that are as good as the people who invented the thing, like invented this new way of having protection and supercharging the upside in a very systematic way. Like one of the people who is a co-founder of Simplify is David Burns. He was an MIT PhD in quantum computing, like options are really complicated. But like there's linear algebra, all this crazy stuff, decay, a lot of things to consider. Normal person doesn't keep all that in their brain. So to do it very systematically, you have to take into account many different things. So he's doing all of that systematically with software, all that stuff. Very amazing team. Also another person, Paul, he's one of the co-founders, and he started ETFs, like $1 billion ETFs. And then David risk managed $4 billion funds. So this is like a very solid execution of options. This is not some blind, like, I'm just going to do 10% out of the money puts and do it forever kind of strategy. This is a very thoughtful execution of Convexity. And it's applying it in a new way. So this is already first to market product of Convexity. Now it's putting this first to market idea onto disruption. And remember, if things move as expected, it will slightly underperform by the cost of carry, right? And if everything's flat and like nothing happens to the stock market, it performs normally. So the idea is, what if there's a partnership between Volt Equity, my company that comes up with the growth companies to invest in, and there's a partnership with Simplify that applies this proprietary technology to supercharge certain investments. It's like a great, like, it's like a match made in heaven, because because Convexity goes even crazier if it moves unexpectedly. So you're picking stocks that you think will move unexpectedly, so you can get outsized exposure to the upside for a very limited amount that you're putting in. So one thing about the way that I was investing, yes, I was very bullish about Tesla, but I also was in cash for a lot of that run up. I mean, I exceeded the 10x, but I was in cash for, I guess, many different reasons. I think it was because I was also starting this company, and I intend to invest a lot of this into this company. But I was able to gain I did over 10x because of options, but I did still have exposure to the upside for a very limited amount of money. So even though I might have been in a certain amount of cash or like other investments, stuff like that, I still got the return as if I was 100% into Tesla. And of course it was majority Tesla, but it was as if I was purely 100% Tesla and more than that, because I had a small options exposure. And like I was saying about that thing that you buy for $3,000, and then if that works out, then it's a huge outsized return. Just a couple of those options can give you exposure to the upside if placed correctly, right? So I think that was really attractive to me, because I don't have to risk losing everything. I only have to risk losing a small portion of my portfolio. I can lock in these massive gains that I had, but still have exposure to this upside if this company is indeed disruptive. Because at that all the way up, people were like, this is a bubble, this is a bubble, this is a bubble. There's no way it's going to keep going up. But in my mind, I'm like, there's a real possibility it's going to keep going up, and it's more than 1% or whatever the market is saying the probability is. So I get that exposure while limiting it to a smaller portion of my portfolio, so that even if I had a positive expected value and it crashes or something, my portfolio is not ruined, right? So you get like for the risk that you're taking, you can get outsized, returns. And when I found Simplify, they were like, hey, by the way, we're doing this, right? It was a stealth company. So I just signed up for, random reason why I was talking to the founder. He didn't say what he was doing. And then I explained my story, and it was just like, dude, this is Convexity. Like, I was already a Convexity investor, and they were bringing a first to market Convexity product. And then it just became a partnership. We weren't even intending that. And so it's kind of an interesting story.
That's really fascinating, man. Awesome. Let's move on. That was really great. So we would like to focus on more I guess, market specific stuff. For example, you're a growth investor, right?
Yes.
Did you read the latest newsletter I sent out?
Yeah.
Sort of like the letter to growth. Okay, I see you smiling already. Okay, for those who didn't get to read it, it was basically saying the recent outperformance of growth versus value, and seeing how usually value performs growth, but in the last 10 years, growth has really outperformed value by a lot. And it's all growth, but mostly just large cap growth. And all of the wealth creation is just concentrated between a few large cap growth companies. And the newsletter was basically saying to diversify into small value as well, just to get like a full exposure to the market. So as a growth investor, what's your conviction and why do you just believe that growth will continue to outperform value for the foreseeable future?
Yeah, that's a really good question, and I understand the viewpoint that people are coming from, and it's a very common viewpoint, right? This has worked for a long time. I mean, just look at Warren Buffett's, returns. It's been amazing, and it's absolutely amazing. But in the past 10 years, I don't think he's really been beating the S&P 500. But for the vast majority of his career, he was like really spot on doing this value investing. And I think that this recent surge of growth investing exceeding value investing is not a fluke, because one perspective is you can view it as cyclical. So therefore, these value stocks are super cheap and now's the time to pour into value stocks. Or you can view it as a paradigm shift, and everything that was correct before is not correct anymore. Just because the stock price seems cheap, it's actually a trap. It may not actually be cheap because they're going to be disruptive. So do you want all the media companies, including all the newspapers that are going to go out of business? Or do you want to focus on these crazy companies that are the future growth and their numbers don't make sense right now, but they will in 5 years kind of companies and be part of the future? And for me, I want to be part of that future. And I believe that there's going to be a crazy disruption and continue to have disrupted industries going into this next decade. And the way that looks, especially with technology, is AI is going to change everything. So like the way AI works is the more data you get, the better AI works. Like people are not programming everything by hand anymore. There's been such a upsurge in the power of AI and the potential of AI that hasn't even been scratched yet. So the reason why Alexa and Siri and all these things came out is it was like this. I mean, people can't see this on Spotify, but it was straight vertical because it was really crappy voice recognition for a long time. And suddenly the quality of voice recognition just shot right up. And that was because it was not programmed as an if-else in programming language. It was trained in AI. And AI is now to the point where if you feed it enough data, it will just understand. This is why Google gets better and better every time someone searches for something. It kind of knows what you want to look for.
Yeah.
And it's really hard to start a search engine today as opposed to before, even if you have a lot of funding. Now, what this means for the investment world is that these companies that are very big, people can say, oh, they're so big, it's going to cycle out. Well, that paradigm may not hold true if AI helps them secure that advantage. So when you look at this new landscape, just because they're big doesn't mean that they can't keep growing bigger, like Amazon, and get better and better and more relevant results. It all depends on their technology infrastructure. Of course, there are some overvalued growth stocks that the general market do not understand. Like they don't use AI, they don't do all this stuff. It's very easy to recreate their tech, but they still pay a ton for it. But yeah.
Something that you did bring up is that just because these companies are big now, doesn't mean they won't be big in the future. I completely agree with that. But size does not equal return, right? So if Amazon is big today, this is just an example, by the way. So let me just say, if a company is big today and a company is big in 2030, so this is being recorded in 2020, the company is big in 2020 and the company is still really relatively just huge in 2030, that doesn't mean that company has outperformed the market between that decade, right? There are huge companies that have just not outperformed. So, and I think my initial question was like, why you thought growth companies would remain big, but I guess the real question should be, why do you think growth companies will continue to give those same kind of outsized returns?
I think you come upon a very important point. Yeah, I'm not saying that just because you're big, you automatically have this advantage, you can keep growing. I mean, it might, like you're sharing, underperform the broader base index, and for a lot of reasons, because of bureaucracy, because of all the stuff, they're just too slow to move or innovate or do anything. So it's usually ends up being pretty unattractive investments. Now, just because they are big does not mean that they are infested with bureaucracy, though. So there are a lot of companies that hit 100 million and then they just stay there, zombie-like, for years. And there's a lot of companies that hit 1 billion and the same thing happens. 2 billion, 50 billion, same thing. But yet companies like Amazon, they've kept growing and now they're over $1 trillion. And the reason is, like, you see them like, oh, they're now going into this. Oh, they're now going into this. And they're like disrupting left and right. And you look at their culture and it's a culture of innovation. So the key to Amazon is that culture where they're always questioning the status quo. Like they take the head of books, right? And then they make him the head of Kindle and say, hey, the future is digital. You disrupt your previous industry. You know everything about print books, but now you're head of this and make it disruptive. And they have that kind of culture. Now, will a big, stodgy, normal company that is resting on their laurels think that way? They wouldn't think that way, but Amazon does. And that's why they were able to sustain that growth over decades, is because it's internal to the culture. Now, some companies, they're one and done. They had an innovative idea, but then it just kind of dies off. Like the founder's not there or whatever, and they don't continue to innovate. And then they sap out all the gains from that one idea until it's dry, and they slowly lose market share to the innovators. So it's really important for disruptive companies to identify, are these disruptive companies? Do they have groundbreaking ideas? But not only that, more importantly, are they innovative and have a well of innovation that they can continue to apply to more and more problems to continue to feed into this growth? So yes, within large caps, there's a lot of traps where they're continuing to lose market share slowly and bleed dry because of bureaucracy. And there are some large caps, for example, Tesla, that continue to innovate. And there's a lot of fields to disrupt that they're continuing to look toward that will continue to feed them and allow them to get a bigger market cap. I'm probably butchering this quote, but someone said that diversification is kind of like ignorance, right? Or like, if you don't know what it is, then just invest in everything, right? And that's like one way to approach it. But what if you actually thought that certain investments are better than others, right? And I think that's even Warren Buffett, the quintessential like awesome value investor, thinks that way. That there are some companies that are way stronger than others, and basically 20 stocks propelled his entire portfolio to this crazy valuation right now. So he concentrates. Actually, that's a very concentrated for a typical approach to this. Yes, if you buy the whole basket, it's going to crash. So in the dot-com crash, if you bought Cisco, for example, it crashed like 90%, and it actually never recovered to the highs of that crash, of the peak. So that's super scary, right? But if you look at Amazon, it also crashed 90%, but it's way exceeded the peak of the 2000s. So I believe that it's very important to be thinking about why it's moving up, because there's going to be a lot of people who are investing just because it's moving up, including pumping up very poor stocks that like make no sense even in the growth world. So for example, Nikola and stuff, everyone was pumping it up to multi-billion-dollar valuation, because they don't understand that they don't actually have any technology. But if you analyze these companies, you would think that Tesla and Nikola are complete worlds apart. And there's no way why Nikola should be worth billions of dollars, because they have nothing proprietary about what they're doing.
I'm not saying you're wrong, but I'm also saying you're a Tesla bull. Just kidding.
Yeah, touche. But all I'm saying is people are just investing everything into electric anything nowadays in the current climate that we're in. But then I don't think that's a good idea. Even in the short term, you might be thinking that it's outperforming because it's momentum. But I mean, like you were saying, when it cycles away, a lot of the weaker companies are going to go away. So what I'm saying the value in is there might be value in systematically, very thoughtfully picking very strong companies and anchoring on that, looking at their culture. Do they have innovation? Do they have all these things that are consistent with disruption? Like we've kind of shared common work experience with Disruptive company. And we've seen that. So if they have the culture that's consistent with disruption in the long run, I mean, that's very, very attractive. So there is a value to actively kind of picking that, or I believe that there is. And that's totally different from just picking the whole basket of whatever's moving the fastest.
There's some weight to that. Awesome, man. Yeah, just wrapping up here. I've taken quite a bit of your time. What to you makes a successful investment?
What makes a successful investment or investor?
Investment.
Oh, investment. I think it actually, in a lot of cases, depends on your life situation, right? So, I mean, no, I'm not like a investment advisor to any people or anything, but like basically, the way I view it is, if you're like really young in life, that may be completely different than you're a year away from retirement and you're about to move into the house in like Florida or something. So the goals are different. Your risk tolerance might be different. I don't view that investors as a particular type of person, like, oh, they've got a certain risk profile forever or certain things forever. Like certain things might afford them what they need in that stage in life. Now, for an investment, they all have different behaviors, right? So growth stocks have completely different behaviors than value stocks. Bonds have different behaviors, and they all have different needs and things that they're very good at for those particular things, and some might be appropriate versus others. Now, if you're maximizing for long-term return, then yeah, what stock is maximizing for long-term return? And I would argue that growth stocks are pretty, if you're in the midst of a technological revolution, could be pretty attractive. And people can argue, well, you get dividends with these other stocks that are stable, but the stock price kind of goes down exactly by the amount of the dividend. It's kind of priced in, So if you look at the total return, I mean, I think if there's a changing of the guard coming, then it's good to be ahead of that trend and be part of the future.
Awesome. What are some must-read books? What are your top three books you'd recommend everyone read?
So this is really weird. Growth investors, they tend not to like books from value investors. But I actually enjoyed reading Intelligent Investor by Benjamin Graham.
That's the #1 book on the show, and I feel like ever, but I've actually never read that book.
Oh, okay. Yeah, it's a lot of it is actually not relevant. Like there's a lot of things that talking about these companies that it's like, I don't know what this company is, But I think the whole idea of, hey, what I take away from it is you can be ahead of the market if you use very smart analysis. So if you, that even if you're a value investor, it's same thing holds true. It's not like there's amazing opportunities in value right now, But say the whole entire, market is like really disparaging a particular stock, but from the fundamentals and just by the cash balance itself, it's worth like 5 times more, then it totally makes sense to purchase it right now. Stock market is a voting machine, but in the long term, it's a weighing machine. And if it's a solid company, you actually preempted the market by getting in early. Now, that kind of thinking can also apply to growth investment, that the market does not understand it because there's all the psychology involved and all this stuff, but that this is undervalued and you still invest. Of course, we're a different set of criteria. It's not because of balance sheet, not because of PE ratios, different things, but you still think about it the same way. So in that way, I like Intelligent Investor. I also like recent book, Psychology of Money. I thought it was pretty interesting.
Okay.
I just like how it talks about psychology, and there's a big part of psychology in investing.
Yes.
And that's super important. Like, just I've experienced for myself how much it can affect my own thinking, my emotions and everything, and like you were mentioning in your article, like, even though that something is the right decision over 30 years, when you're in the thick of it, like, you think that the world is ending, it's very easy to press the sell button,
Yeah.
So I guess it's kind of good to know how everyone behaves, including ourselves. Like, we're tempted for a lot of things, and you have to ground yourself in knowing like what's actually going on when things are going on. And that's why I really like your notes, is that you talk about that, very, very few people talk about that it's not just theory, but it's about living it out in real life.
I think people who only read investing, finance, or economics books are typically make really bad investors, because you don't understand how people work, right? And for me, I think those books are really important and I enjoy them. But people are at the core of everything. If you can figure out how people behave, all investments might change, companies may change, market conditions may change, people stay the same. It takes us millions and millions of years of evolution to change. So through your lifetime, the only constant thing would be people. And if you can just understand how people act, and honestly, all the bets. So usually I'm a pretty typical, well, I would say I'm typical, like I use a lot of options and stuff like that. So I won't say I'm like, the typical investor, but some of the craziest bets I've placed and I've been profitable, I've just come out from understanding the psychology of people, right? A lot of people look at the market conditions, they look at everything. Sure, those are all important, but ultimately what helps me make my final decision is just behavior and how I feel like people would either overreact, underreact, or what people may be thinking at that very moment, and even if it's true or not. So thank you. I'm really glad that you find the newsletter useful. Do you know of any young investor or someone that others can learn from that should be on this show?
Yeah, another type of investor that could be on this show. I think I really like Galileo Russell from Hyperchange.
Oh.
So I think that he's really good in epitomizing like what is so groundbreaking about like Tesla, for example. And I know it might seem like kind of, oh yeah, going on Tesla horse again, but
Oh no, definitely.
I think it applies to many different growth investments, like the way that he thinks about things. Yeah, like that the technology actually matters, and sometimes you can have an advantage that the market has not realized yet. For example, a core technological advantage, and the market does not price it at that until the technology is deployed.
Yeah.
But you can get in potentially before the technology is deployed, and that's the growth potential for a growth stock. So in that way, and he talks about stocks a lot. So yeah.
Is he a YouTuber?
Yep.
Oh, definitely. Okay, thanks. Thanks for that recommendation. Now, I gotta ask the final question, man. what was your percent return on Tesla?
Yeah, I mean, I haven't really kind of counted it all.
Oh, it's that good. It's
No,
that good. Let me
Okay,
guess.
no.
You don't even count it in percentage. You just count it in X's. How many times your money doubled, right?
But let's just say I've slightly exceeded. I'm pretty happy with the return because I've slightly exceeded what it would have been if I was in 100% Tesla stock.
Okay.
And the reason why I'm happy, even though I slightly exceeded that, is because for the risk that I was risking, I thought it was an excellent return because I was able to take part in the wild run up, but limit my risk with options.
Good option.
But it was roughly as if I was holding the stock.
You were holding it. Awesome. Awesome. Well, Tad, this has been great. I think this is the longest episode yet. Thanks for coming on the show.
Thanks for having me. It's just awesome talking to you. It's very interesting conversations every time.
Awesome. Awesome. Well, see you soon, man.
Okay.
Hello, hope you enjoyed that episode. You can support the show by subscribing wherever you get your podcasts and leaving a review. We're also on YouTube if you'd like to watch us smile and laugh as you listen. Also subscribe to my premium newsletter at tolusnotes.com. That's TOLUSNOTES.com for timeless lessons for young investors. See you next week.